Kenneth Andrade joins us now. He's been interacting with him after a while. Ken, fantastic to have you back. Thank you for joining us. Hope all's well and things are fine with your family in Canada and your daughters are doing fine.
All perfectly well, Nichols. Trust all the same with you.
Thank you very much, Ken. So, what's your market view? The space where you invest, which is the small and the mid-cap space, has got completely smashed out of shape. It could happen because of market, it could happen because of liquidity, but that's the space where you expertise on. That's the pitch where you bat. So how are you dealing with this market googly for that space?
Sure, it's been a very long time since I've seen something like this. And actually, I haven't seen something like this, which essentially started out in the beginning of 2018, and we're almost midway to 2020. But there is some revival that's happening across the board. A lot of businesses have restructured themselves, and they've become very averse to picking up incremental amount of debt. So I think balance sheets are corrected. Balance sheets corrected in 2019, and they're seeing an incremental correction in 2020. And I think you're way past the risk zone as far as that part of the world is concerned. Sure, there's been an impact on pricing that is there, but that impact on pricing over the last quarter has been across the entire market itself. These companies or the mid-market companies have been in the bear market since 2018 or beginning of late 2017, beginning 2018. My sense is a lot of them are bouncing back purely based on asset valuations on the ground and nothing more. But if the economy actually holds up and there's some element of fragmentation that takes place, these guys will come back.
Ken, you've run a portfolio, and I distinctly remember when we spoke, is that you've got almost zero exposure to financials and a very large exposure to agri. Now, you underperformed for the better part of 2019 because financial is where all the party and all the fun and all the glory was there. But now financials are underperforming and rural economy is making a comeback. So are you in a good spot now, considering that everybody is talking about buying rural and selling financials?
It's too recent to talk about. And even if it's doing well, there's a lot to catch up on 2019. But yes, 2019, we were out of two spaces, which was consumption and financials. And actually, both of them were playing the same cycle because private sector financials were up, NBFCs were up, and consumer businesses were up. So anything from discretionary spends, which is automotive, jewelry, retailing, etc., to FMCGs and the likes of them, both were up. So you were playing a leverage trade on the consumer cycle, and that J curve in consumption happened towards the lag end of this decade, and that's what we stayed out of. So in a sense, the decade that went by was all about financials or the leverage play on the consumer cycle, and you saw a magnification of that in some of the financial stocks that were there. So yes, 2019 we were out. We held on to where we were investing in a little bit of infrastructure that never played out. The agri part of the entire portfolio, which has done reasonably well. Some of them are at lifetime highs, and we're looking forward to manufacturing and some of the basic commodity businesses or basic utility businesses that exist in India.
Okay, so let's address the stress point for the agrarian economy. Given that right now there is a huge demand and a supply crunch, some would argue that inflation will not come back. Globally also, commodity prices will remain soft. While there is merit in understanding that the agrarian economy or the rural economy will come out on the right side of the lockdown, because that's where the lockdown effect was not there. What happens to the underlying income of the rural economy? Because if commodity prices and if demand remains under pressure, the ultimate objective of income creation will get defeated.
So let me clarify a few points out there, Nikunj. The agrarian economy is too small to lift the GDP out of the decline that it is in. Okay, if at all, it's a very tiny portion, which is 15% of the global GDP of India's GDP, and that's not going to come down over the next. And that's not going to go up anytime soon. It's actually going to come down. Globally, in most Western countries or most developed countries, the percentage of agriculture to GDP is significantly under 10%. So that's a trend that we are heading in. Our view has been a little different. So apart from what's happening right now, if you look at the Indian agricultural sector, we are somewhere in the region of about 15 to 16 lakh crores. This is just agriculture, right? Sorry, this is just the farm economy. Out of the 15 lakh odd crores, about 8 lakh crores is just farm incomes or wages that go into that part of the world. And given what's happening on wage inflation and availability of labor, the potential of technology playing a role out there, which is inputs and which is in farm inputs, as well as mechanization, is significantly large. So it's a slightly different view from what the market perceives, which is very recent of time. And that industry is fairly consolidated. I mean, in farm equipment, you don't have too many participants out there. In agricultural inputs, you see the market consolidating significantly because there's no new participant in the last 20 years in that part of the world. So we're playing a very finite space. It's slightly longish term, but you probably hit the peak of return sometime near, and that's also due to where the environment is and where all the noise is centered around, which is the rural economy. So we might hit the I wouldn't say the mid cycle sometime 2020-21. And after that, it would just it could be a steady compounder post that.
You know, we had a very engaging conversation with Ashwath Damodaran last week, Ken, and his view was that, look, it's great to talk about value, but guess what? Value investing has not made money in last 10 years. And in the post-COVID world also, value investing or high dividend yielding stocks are not making money. So what is your view on, for a lot of market participants who are saying that, look, it's time to buy deep value, buy stocks which are below book, buy companies which are trading in single digit P multiples and have yields of 4 to 5%. Are you looking at migrating towards deep value? You know, thinking, I mean, a lot of people are saying that iska bhi din aayega.
So I haven't thought about investing any differently for since I've been in the asset management trade, and it's worked for us, worked for me, worked for the organizations that I've worked for previously, from 2003 to 2015. Even 2016 and 17, we did reasonably well, or we did far better than most of the benchmark indices and the peer group in trying to go where parts of the market were completely ignored, and were able to capitalize on opportunities out there. I think 2018 and 2019 were 2 years where it's been a little difficult to find opportunities, or should I say the momentum of something that was moving, continued to move quite dramatically. So I'm very much old school. There is a certain level of asset valuation that is there, and there's certain capital efficiency norm that companies have to adhere to for them to become significantly large or attract more capital. And capital will get expensive. Capital will get expensive over a period of time. So I belong to that part of the world, and I'm sure if I can just put 2019 behind, I don't think we'll have to revisit how value investing works. So it works. It worked across multiple cycles. It worked in my favor for the last 2 decades, and it's just been 1 year that it's been off color. But apart from that, it's been fine.
How has your portfolio changed pre-COVID and post-COVID? The world has changed, and there is no harm in changing portfolio, because if the world has changed, you need to align with the new reality. How much of your pre-COVID portfolio is different from your post-COVID portfolio?
We probably turned around about 15% of the portfolio, but nothing significantly more than that. Let me put that also into context. What you saw and when we put together uh, 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 our strategies in 2016 and 2017, we were looking at the consumer part of the cycle, and I came from an organization, and I came from a portfolio that was very consumer intensive. We also had significant amount of financials in that part of the world when in the earlier part of the decade. Now, again, when you're playing into a market cycle which is building up on valuations and the trade is getting crowded, obviously you will have valuations go to levels that you haven't seen before, and that's what happened in the consumer trade. It's very like the infra trade or the materials trade that took place in 2008 and in year 2000, wherein the tech trade took place. So these valuation bubbles do take place, and the decade after that is completely different from the previous one. And it usually starts where there's reasonable amount of value, no competition because entrepreneurs are just not attractive because there is there's low profitability in that pool. But over a period of time, when demand comes back into that cycle, there's a rush of capital out there. So you'll have to look at it from a market cycle point of view. Don't look at it from the last 18 months because the last 18 months is not what happened in the last decade. I couldn't buy I couldn't buy a garment company at 15 times earnings in 2008 or 2007, and then buy it again at 60 times earnings, saying it's the same logic that follows. Okay, so that's been our worldview of the valuation cycle. So yes, there will be in in the interim there will be parts of the market that you will allocate capital to that doesn't work. But if you take away or if you operate in a space which is 40% of the market and 60% of the market is currently attracting all the capital which is there, which is financials, consumers, and businesses in line with it. And if you operate in the other 40% of the market, which is where we are, we are sure that over the next decade, that 40% will flip over to being 60% of the cycle in times to come. So that's our limited play that we have currently. We do manufacturing. We've got reasonable amount of businesses facing the farm sector, consolidated businesses, no competition, reasonable return on equity, cost of capital for participants out there are coming off, and that's the cycle that we're heading into in the 20s.
Fair point. So my next follow-up question is that while we talk about manufacturing and the cyclical upturns and cyclical stocks, the grain of the truth here, Ken, has been that none of these companies have managed to really achieve something extraordinary. One is that companies may suffer because of a cyclical downturn. Second is that Indian manufacturing have really the ability to scale up. Minus the exception of one or two companies like Bajaj Auto or Dixon or maybe an L&T, very few Indian companies have been managed to have an edge or a global mark. So I am just getting more and more convinced that the scope of manufacturing is great, but perhaps the potential and the ability of Indian companies or entrepreneurs to deliver on that front could be very, is actually not great.
So everything is true in hindsight, and if you go into a business which is reasonably a favorite amongst all investors today, which is pharmaceuticals and chemicals, the latter more in point than the former. Look at what has happened out there. Okay, it started with a trade, which is a migration from the Chinese economy to the Indian economy, from China to India. And you got an opportunity to prove your credentials on smaller volumes. You haven't defaulted, or you haven't, and you've been part of the supply chain now, and your incremental growth has shown the ability of you to handle larger volumes. That is all that large buyers look for. Okay, and that's how that transition essentially comes through. So I wouldn't expect an Indian manufacturer to come out, put in $1 billion and be a $1.5 billion turnover business overnight. It doesn't happen that way. It's a great gradual process, and that process is about aligning yourself to what's required by your customer. Once you've been able to fill that slot out there, you are happy to go. Look at the ceramics business in India and go back about 2 years, and Morbi, which is one of the larger ceramic manufacturing belts in the world, was struggling. Okay. Today, very few of them have capacities which are available. They are virtually all booked into the international market. So those are small industries that are finding their niches and participating in what happens to be an economy or an Indian economy which is looking outward for demand. And that is also where the scale comes in. Okay, we've done it in agrochemicals, we've done it in pharmaceuticals, we've done it in IT. We've done it in to a very large extent. We're doing it in ancillaries, in the auto ancillary space. I'm not. I'm the optimist when it comes to looking at that small part of the world wherein you take individual industries and there will be entrepreneurs with no help from the macros who will make it reasonably large into the global arena. So that probably is a very large trade that will take place in the next year. And you won't have a full participant, you won't have a whole leg of companies going there. You'll have a few of them that will format their way into that part of the world.
But some would also argue that, look, the simple businesses also, like autos, or for that matter, consumer durables, they also are attractive because they've also corrected. Maruti has come down from 10,000 to 4,000, Bajaj Auto from where it was, let's say 3,000 to 2,500. Shouldn't one keep it very simple and bet on revival in consumer demand when consumer stocks have fallen, auto stocks have fallen? How about walking towards that path?
You always have that option to do that, and it's always happened in the past. So it's not that these are not good companies. They are good companies. Are they good stocks? They are also good stocks, but there is limitations on how much they can achieve. Look, Maruti did what it did after it hit a cyclical growth rate of probably about 15% for almost 7 to 8 years. Okay, will that 15% continue over the next decade? I seriously have my doubts, which effectively means that you are addressing some of these businesses that have approached a mature industry. And when you hit maturity as far as the industry is concerned, you probably don't return back to the same valuation peaks that you've done before. So if you have to compound returns, compounding of returns is when your growth rates are high and then your multiple expansions happen. And that's not the case in some of the names that you've actually put down there. A lot of them will make their new highs. I have very little doubt about it. But there's something else that will reach them much faster. So when you gave away the tech trade, the old economy came back. And if I just take a flagship of the old economy or the poster boy of the old economy out there, L&T did significantly better than Infosys in 2007 and 2008. It's not that L&T didn't come back in 2012 with a new high. It's someone like a Bajaj Finance and Hindustan Lever who actually took over from there and created what was there in 2019 and 2020. I'm not saying that these companies won't come back to their previous highs. They will come back to previous highs. But what's going to do something superlative in the next decade? And that's how your cycles change. So when you're trying to when you will build up into a next bubble. What that next bubble will be, I have no idea. And you probably have to stay away from the one that has actually gone by in the past, and you'll be able to find the other extreme of the market. So that's what we're trying to do. Valuation multiples will climb in a number of industries, and growth will come back. You have to be out there to find it. The other passive way of actually doing it is align yourself with some of the better companies that are already there in the cycle, and you will make your normalized returns. For me, if I have to allocate capital, or as a manager, if I have to allocate capital, that is my bond investing book.
Okay, so Ken, what will you not buy right now? We only always tend to talk about what is good, what to buy, where things could go higher. What will you not buy in this fall? I mean, when you decided not to buy financials, the P multiples were different, interest rates were different, valuations were different. Would you be now looking at tempting financials also? I mean, no harm in buying when things have fallen.
So you could head that way, but the choices that you have are far too few. Okay, and the ones that you actually would participate with are not by any stretch of imagination cheap on a global context. India is one of those places in the world where you get good quality financials at a very elevated price to book multiple, and that's steady state where it comes for now. I'm slightly anti-consensus here when I say that that part of the trade may not come back for some time. So financials are, look, it's a leverage play on the economy. I mean, you take 10 rupees of equity, you multiply it 9x, okay, and you got a leverage play on the economy. The other part that investors don't like is leveraged companies. If investors don't like leveraged companies, why are financials so attractive? Okay, but financial and if I have to just take this trade and buy low valuations based on historic earnings, I am not really looking forward to see what's really going to come. Let's trade back to 2011, 12, 13, where all of us tried to pick the bottoms in public sector banks and see what's the state of the public sector banks today. I'm not saying that will be the case of private sector banks that is there, but I'll go back to another industry, which was pharmaceuticals. And you had peak valuations, you have peak earnings somewhere in 2015 and 2016. And look what happened after that. So prices correct first, the news comes afterwards. And then when you have a falling denominator, which is the earnings of your price earning multiple, things don't look very attractive. It won't look very attractive going into the next 2 years. So I'll hold my optimism on that part of the world, saying that stocks have fallen, I need to rush out there. Sure, there'll be one or two businesses that will come back. We do have a look at them once in a while, but that's not where we are focusing all our energies.
Really appreciate your time. Thank you for joining us. Stay safe, my friend, and always look forward to our interactions.
Take care, Nikunj.